In late 2024, the Nifty Index climbed to 26,000. Portfolios across the country were showing record green positions, and retail participation reached levels rarely seen in market history. As the numbers climbed, the volume of buy orders from individual traders accelerated. This buying spree continued even as prices moved further away from the underlying value of the companies being traded. Between 2020 and 2024, the market was running on a liquidity engine. Cash was flooding the system at a rate that outpaced the actual growth of corporate earnings, creating a disconnect between price and reality. When record numbers of participants believe a trend can only move in one direction, the psychological conditions for a sharp reversal are in place. While retail buy orders were peaking at 26,000, institutional investors were beginning to manage their risk with a different set of calculations. This period marked the distribution phase. Institutions began selling their holdings in small, controlled blocks, transferring ownership to the eager buyers entering at the top. Capital began flowing out of themes that had seen the most rapid expansion. The defense sector, which had become heavily overowned, was one of the first to see significant institutional selling. Next were the PSU railways. These infrastructure themes had been a central part of the recent rally, and institutions used the high retail demand to exit these positions. By the time the market's upward momentum stalled, a significant portion of institutional shares had already been moved into retail portfolios. This chart shows the Nifty's breakdown, a sharp 15% correction that saw the index slide toward the 22,000 support level in a matter of weeks. As the price fell, it triggered stop losses and forced the unwinding of leveraged positions. This created a cascade of selling as portfolios began to show significant losses. From an institutional perspective, entering a position at this scale requires massive volume. If a fund tries to buy billions of rupees worth of shares during a quiet period, their own orders would push the price significantly higher before they could finish. To buy at scale, these funds need an equally massive pool of sellers on the other side. The high-volume selling generated during a retail panic provides the necessary liquidity for institutions to fill their orders at stable prices. What appears to be a chaotic drop is actually the mechanical process of volume being transferred from those selling in fear to those buying with a long-term plan. To see where the market actually stands, we have to look past the price charts and examine the underlying mathematical metrics used by institutions. This is the index PE ratio. Valuations have normalized, moving from an expensive level above 25 down to a sustainable range of 20 to 21. The index has returned to its historical median of 21.9. This isn't a collapse, it's a return to mathematical equilibrium. This chart shows the price-to-book value. The high premiums have been erased, returning the asset valuation to a neutral level of 3.2. Finally, look at the dividend yield. Major market bottoms typically see this yield spike toward 2. The boredom of a sideways market often leads to final sell-offs as traders look for excitement elsewhere. This period is the accumulation phase. Institutions use this time to quietly absorb those sell-offs, building their positions without causing a significant move in the index. This lack of direction acts as a filter, removing short-term speculation before the next growth cycle can begin. During this phase, institutions focus on sector rotation, moving their capital into areas with high earnings visibility and more reasonable valuations. Large-scale capital is currently moving back into the banking and financial services sector as valuations began to stabilize. We are also seeing defensive accumulation in the pharma sector, where earnings are more predictable, regardless of broader market volatility. The IT sector is also seeing renewed interest, as it enters a valuation zone that institutions find attractive for long-term holding. Generations of market data lead to a single conclusion. Wealth is built by those who can tolerate the silence of the base. Wealth trend mein nahi banti, wealth base banne ke dauran built hoti hai.